Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about home prices and what it would take to crash prices or have them accelerate this year. First, I want to thank our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. We're both in Texas now, so
Yes, we are. You are here for a event with Fairway, right?
yes, I'm going to speak in a few hours here. And it's going to be fun. After that last existing home sales report, man, it is going to be a very, very, very fun start to the year.
Well, this leads me to our topic for today, which is home prices, right? We have a lot of variables to look at now. 2026 could be interesting. Let's start with your forecast for home prices this year.
So, keeping in theme with the chart daddy doctrine, it's going to be a tug of war. Now,
Right.
we always believe that a forecast is useless without a model because things change during the week. So I have had a very, very slight decline. And if you look at the history of home prices after a period, if inventory is growing and rates aren't really breaking too much lower, then you kind of have like a flat or maybe down just 1% or 1% a year. So we're going to go off of that principle. But it's 2026 now. It's 3 years after that fastest crash in home sales ever. And a lot of people said prices follow volume, except that's never been the case for 8 decades. So again, like why didn't home prices crash last year? And what do we need to look for in 2026 if that was going to be the case?
Okay, well, what do we need to look for?
Okay, so number one, the history of nominal home prices crashing nationally is very rare, right? I always like to use the Case-Shiller Index going from 1942 all the way to 2025. Remember every year we wrote that article, like why didn't home prices crash? And we list all these reasons from 2012 all the way to 2024. And last year, I was going to be done about that. But last year, there's a lot of reasons, people talked about sexless men, no joke. People talked about,
Right.
the silver tsunami. People talked about FHA loans and everything. None of those things matter unless you have the data to justify it. So, uh, household balance sheets are so good now compared to any other time in history that it's almost a joke that people think home sellers are majorly stressed. But let's just take a hypothetical. Let's say I really believe national nominal home prices are going to crash this year, even though the forward-looking data has gotten better. Since when, Sarah?
Mid-June.
Mid-June, June 25. June 2025. So not only has demand picked up, but the growth rate, right? Supply and demand equilibrium. The growth rate of inventories slowed down noticeably and demand picked up. Don't make it any complicated than that. But number one, let's do hypothetical. Let's say Logan is intoxicated like crazy and it became a doomer. What I would need to see is that our new listings data that we've cherished for so many years, that we have told people that if there was ever any kind of stress in the seller profile, this thing will go vertical. It has not gone vertical in the last 3 years. So the people that have been telling you home prices are crashing and all that stuff on a national basis don't have the training to realize that the inventory curve would have to go really bad. So we're sitting here, the NAR's inventory data, 1.18 million. Back then in 2005, active inventory was 2.5 million, and then sales crashed for 3 years. Well, that 3 years, inventory actually shot up to 4 million, right? New listings data was what we call, if it's above 80, if it's above 100,000, then it's something abnormal.
100,000 new listings coming on per
Coming
week.
on during the seasonal peak period, right? So it's a very seasonal data line. 80 to 100,000 would be normal. If we saw stress, like people say, like, oh, home insurance, people are stressed. Credit card debt, they're still using the credit card debt. I'm like, homie, it's 2026. What happened to 2023, 2024, 2025? Ah, well, it lags. Homie, it's 3 years. It ain't lagging. But let's say hypothetical. Let's say credit card debt. Americans are struggling and they have only $200 in their savings accounts. It'll go vertical early, right? It will. I mean, we're not even talking like 80 to 100,000. We're talking about 200 to 300,000 new listings data accelerating in a very high clip. These are sellers that are not normal buyers, they're stressed. So always keep an eye on the new listings data going early into years. So by May and June, you get a really good tell on what's happening. If you don't see that data line breaking up in a bigger fashion, that means we have kind of a normal buyer versus seller year.
Well, and obviously the last time we saw like 300,000 per week and more was, 2008. So there would have to be something crazy going on.
It was that period of time. And what's the tombstone chart that, when I pass away, you're gonna put it on my tombstone, right, Sarah? What is it? It's the foreclosure data. So in that foreclosure data, what that is telling you is these are in the credit reports, you're getting a foreclosure in there. That process is starting. So in 2005, 6, 7, and 8, that data line was breaking out, right? That process was in motion. We're not even back to pre-COVID levels. Oh my, for the life of me, now that we're in 2026, I cannot believe that certain people have not looked at this data and go, maybe I don't know what I'm talking about. When you see stress, that foreclosure data will start to accelerate. And when that process starts, then the new listings data will take off because these are stressed sellers. So let's just say of course there's not a lot of credit stress out there. Let's just say home insurance is stressing people out. Well, okay, you have a lot of equity sellers, right? You got to move it from distressed sellers to equity sellers. That means people cannot afford to make their payments. First, I don't know, it's not in the FICO score data, but whatever. We're dealing with crazy people. Then they would actually list their homes into the marketplace and will sell at a discounted rate because they're struggling so bad that they have to get out. What is one group of people we never listened to, Sarah Wheeler, about housing economics?
Middle-aged men stock traders.
Middle-aged men podcast stock
Oh,
traders.
podcast stock
Those
traders.
people are crazy. They always say, oh, a really good example was in 2020, active inventory wasn't growing at all because of the COVID. So a lot of people said, well, it's a normal year. So mortgage rates are at 3%. Everyone's going to rush to sell their house because they have all this equity. This is what podcast stock traders on margins think like. That's not what normal men and women act like with their homes because why? You have to sell your house and you have to find another form of shelter for your family, good enough for where you could move for a job. So here we are with the credit data looking excellent. Here we are with the equity data looking excellent. But we have podcast stock traders who say people are so stressed, they're going to rush to sell, or we're going to have so many homes come onto the market that prices have to crash. This has never occurred in history without distressed credit sellers into the mix.
And I think that, you always say it's not that there are no foreclosures, right? There are always going to be some foreclosures. And we know that there is some recycling of those like 30, 60-day late, and then they go back into the system, their loss mitigation. We've heard about that, but the numbers are still so small, correct?
1 to 4% of loans are always in distress. That's very normal. When you see an accelerated rate, usually what occurs is you get a job loss recession. People lose their jobs, right? They cannot find work, or the unemployment benefits is not enough. They have not a lot of savings, so they go into the 30, 60, 90-day late, 120, notice of default. Then the foreclosure process starts. That is at minimum 9 to 18 months. That's being very gracious too. There are states that it takes like 2 to 3 years to get it done. So this can't be a 2026 just by the basic laws of arithmetic. This thing had to start 18 months ago.
Right.
This is why I tell you, you have amateur people out there who have never forecasted anything correct because they're not data analysts. You have to create a model for this. So obviously, we don't have the distressed sellers, but hypothetically, let's say if we can't prove that homeowners are struggling, but they can't make a payment, you will see it in the new listings data and you just go with it, right? And I encourage everyone, go back. Don't just look at the national data. Go to your own state, go to your own city. HousingWire is going to have access for so much data for everyone out there. You could just do it yourself and showcase your friends, your clients, Uncle Dave, realtors, loan officers, everyone. You will have the most up-to-date housing data out there in history, but it's live, it's fresh, it's forward. There is no delay. Our stuff is today looking out. Again, we're 3 months ahead of NAR. We'll be 3 to 6 months ahead of Case-Shiller. When it breaks, it'll break. There's no hiding it.
Okay, well, let's talk about the opposite, because we have rates going a little bit lower, right, which can stoke demand. We have more inventory than we've had for the last 3 years. It's a great story, but it's not like booming in inventory. So is there a scenario where you see home prices accelerating this
Not
year?
out of control for two reasons. Number one, active inventory is back to at least normal levels when we get a seasonal curve. Of course, the NAR data is about 1.18 million. That's very low historically. That's below the normal inventory curve. Normal active listings are between 2 to 2.5 million. Okay, I'm completely fine with 1.52 to 1.93 million active inventory. So we got to like 1.55. That's good enough for me. So when we have a normal seasonal inventory increase with the NAR data, then we should be back there at some point. Because of that and because of affordability, it is still hit. It is. I cannot see anything where home prices start to escalate out of control either. So on both ends, on the escalation of prices higher or the crash, we don't have anything in there that could counter. And last year, Apollo, I don't know why they got into the housing discussion, but they did, and they forecasted 10.8% home price growth, and we're all like, "What are you looking at?" So we try to create a model off of that, and we're just saying that the demand has to be so much stronger than the supply. We just don't have that mortgage demand, right? Mortgage demand is key to a lot of housing economics out there because that seller needs a buyer out there. That I didn't agree with what Apollo, and we try to create models off of that, but just we don't have that kind of demand curve to really push prices to escalate out of control because affordability is still an issue. And then number two, the second reason is qualified mortgage. Because of qualified mortgage, it's very difficult to get kind of what we call fluff demand. Like people just, I can put my house in the market and get something right away because credit is so available. Credit is never going to be as available as it was during that period of time, nor can credit get really tight in any meaningful way. If anybody looked at the Mortgage Banking Association's credit index, it has really gone nowhere for a very long time. This is basically how it is. So there's not too much on the credit data, or supply is still good enough out there. So both sides, I think, wouldn't have a valid case out there. But if you wanted to create a hypothetical on prices escalating, that means inventory has to really collapse. And then all of a sudden, rates go a lot lower than what anybody imagines. And there's just a surge of buying, right, in a very, very short amount of time. And that creates an escalation. I don't believe that's the case. But if you wanted to create something, it has to be an abnormal inventory year, an abnormal new listings year, and rates go lower than anybody's forecasting. And just because sales are so repressed for so long, that, as you would say, sideline home buyer, but I would say just a natural flow buyer, because I'm not a fan of the pent up demand the theme either, but sales have been so depressed for so long, and it's not like a UFO came and took all these people out of America. They're still there. Something like that, where you just got a stronger demand curve, that kick up in pricing. And when we look back in history, when you do have a recession, mortgage rates go a lot lower than what we dealt with in the previous cycle, and that has always boosted home home sales vertically. A really good case is the 1980s. Like the first recession in the early 1980s, rates went and then sales has shot up. Even in the second recession, we're so low in sales, but sales have shot up. You need something like that with inventory data. So again, track the weeklies and new listings and active inventory and price cut percentages. We do that for the tracker on a national basis, but I just don't think that's a valid case with where affordability in qualified mortgages.
Which is actually, this is good news. And this is back to your I'm not gonna. What do you call it? The chart daddy
The chart daddy
doctrine.
doctrine.
Oh my gosh! So
You
this is
brought
back
you brought
to.
it up because you said I should make something an enchilada. And I was like, no. And I'm not
That's true. I
calling it a.
did.
We already used the term enchilada, so I say it's going to be the chart daddy doctrine. It's going to be a tug of war, and the tug of war is healthy,
Right,
right?
because the tug of war is between buyers and sellers, and it's just more back to the normal tug of war. It's not like buyers are competing against 25 other buyers for the house because inventory is good. And that means that, it's good news that home prices will be about where they are now. And your forecast you said is slightly negative? I
I
can't remember
have
what you said.
slightly negative, but again, I always tell people a forecast is useless without a curve data. So we want
Okay.
to keep an idea because right now what happened is the early part of the year inventory is cooling down a little bit more, and now we've already seen the demand curve already pick up. So we have to be mindful of that out there. But I've had a slight decline, and that's assuming inventory increases somewhat back to what we saw last year, but it's going to be a little bit more difficult. You have harder comps and you have lower rates and you got better spreads. I'm trying to teach you guys how this all works. With that backdrop, you follow the weeklies, and if the forward-looking data is positive, you have to go with it and forget your priors or ideological takes. Or I love this. I love this reason. People say, "Well, home prices have to fall 15% because that's the only way to get affordability." Homeboy, you are not a seller of that house. It doesn't. Nobody bleeping bleep cares what you think. It's the marketplace. Forget human beings. Human beings have been terrible on this thing for a very long time. The marketplace, data, numbers. Why do we like numbers, Sarah Wheeler?
Closest thing to the handwriting of
Handwriting
God.
of God.
That's what you say.
Yes,
Yes.
and let
Yes.
it take its course. That was the thing that I saw a lot of people late 2022 to early 2023 couldn't give it up, right? Because they were told prices follow volume and you had the biggest sales crash, or we're going to have the biggest price crash. And while the data was getting better, how many videos did we make back then? The data is getting better. Nobody's going to listen to it. The data is getting, and if the forward looking data gets better and sales aren't declining, that supply and demand equilibrium shifted. So this is how you want to look for, especially the first few weeks. But it's really hard to make a big price crash theory. It's also very hard to make a big price gain theory with this chart daddy doctrine, right? Tug of war. Now you can make a case you need to see this. These variables kick in if you're looking for a price crash, but you need to see this if you're looking for a price acceleration. And so far, right now, so far, good, right? Boring is a good thing, right? Here we go. Tug of war. Let buyers and sellers, you get a little bit of breath, and it's good for 2026.
Incredible. Well, we're going to end on that. That's a positive note going into the weekend. I love it. That gives our professionals their opportunity to do what they do best without all this volatility, buffeting the buyers.
Ladies and gentlemen, if you haven't figured it out, Redfin duped a lot of you. And for the men that are listening to this podcast who got duped by Redfin, I don't feel bad for any of y'all because if you just simply read the biggest buyers sellers gap was 2007, not a data line that was created in recent history. Follow the tracker data, guys. It has been very prolific in a very crazy amount of time in the last 3 years. Sales are very low, rates are lower, spreads are going. Work off of that, and then you can be right for the first time in a long time, right? And you don't have to doom porn 24/7.
You don't. And I would say if you don't know where to find the tracker on housingwire.com under the news tab, it's right there, housing market tracker. And if you are not a subscriber, sign up so you can get all of the latest and all of this amazing data that Logan is talking about.
And you can do it for your own city, state, and zip code, right?
Yep.
Let numbers be your guide. Let it guide you all the way to the future because you don't want to wait 3 to 6 months. We literally had people who thought prices were crashing in the second half of 2025, and they're sitting here with multi-year highs in new home sales and existing home sales, and the inventory growth is cooling down, and the price cuts percentage is cooling. So it's like what happened? And it's like just read. Reading is a good thing. The history of human civilization has taught us that those that read have an advantage over those who don't. And even if you couldn't read, I make some of these charts with big crayon black lines to make it simple for you guys.
You're doing all the work here, Logan. You're making it easy for people. They should take advantage. Logan, thank you for being on as always. We will talk to you again soon.